Good day, how are you? Welcome back. And this is Win Yi. So have a lot to cover today on as we move into the last week of the year, December the fourth week. So with that in mind, I have several things to share with you. First and foremost, I'm going to play this video, and I'm going to play this video by just came out from Yahoo, housing market 2023. Key question will be whether there will be sufficient supply. So I'm gonna play this like a 5-minute video, then I'm gonna review it with you guys and give you my perspective. Then right after that, I'm going to go over mortgage news daily to go over the 30-year fixed rate uh, for this past year and from a historical basis. And then I'm going to use the Redfin data toward the end of this year, 2022, from a big picture, nationwide real estate changes. And finally, I'm going to share several slideshows that will depict, in my opinion, as to what's going to go on as we move toward 2023. Right, so thank you for watching. And by the way, toward the end of this video, I'm going to do my recap. And also, I would love for you to subscribe to my channel and click the like button, and so you could receive weekly videos about real estate and real estate investing, as for that matter. Thank you so much. So let's go ahead and play this very, very interesting video. So just bear with me, all right? So here we go.
Then showing a struggling housing sector, the National Association of Realtors of Home Builders CEO, Jerry Howard joined the show earlier today to tell us what they see happening. Listen.
So cost of construction, the cost of capital, it's all playing into it, and that's having an impact where we firmly believe that we're in a housing recession right now.
Joining us now to weigh in on this is Lawrence Yun, National Association of Realtors Chief Economist and Senior Vice President of Research. Lawrence, nice to see you as always. Are we in a housing recession? And how do we define it? We got caught in that trap with the overall definition of a recession recently as well.
Well, good afternoon. I would definitely say we are in a housing recession because it's contributing negatively to the GDP growth. It's cutting into it. Housing starts are down. Home sales are down. There's some layoff in the industry. But the most interesting aspect from consumers' point of view, homeowners, they're doing fine. I mean, they have seen substantial growth in their wealth from rising home prices, very little foreclosure rate, mortgage default rate at historic low. So we have a divergence. People in the industry suffering due to the lack of activity, yet homeowners are doing very well.
So, Lawrence, we have housing starts off 16% from a year ago. Permits are down 22% from 2021 in November. Just in terms of what this is signaling of how much worse the industry could potentially get over the next 12 months. What do you think?
Well, because of the lack of buyers, the builders are becoming very cautious. Now, we have to remember, we had a housing shortage before COVID. Inventory levels were low. Then the first couple of years during the COVID, when the home sales boom, we had an exacerbated housing shortage with multiple offers widely prevalent. But now with the buyers retreating because of much higher mortgage rates are the drivers. High mortgage rates, buyers retreating, we still have some degree of housing shortage, but definitely it's taking much longer to find that right buyer in order to make that sale.
Mortgage rates up on the screen, and they are down considerably, frankly, from north of 7. That's maybe the only good news right now. Where do you think they settle in at middle of next year?
I would say 5.5% is probably the case because we have the Federal Reserve who will continue to raise interest rate probably 2 more rounds. But the mortgage rates have already priced that in that information, and with the inflation expected to retreat, from the 9%, 8%, 7%, and possibly 4% inflation by end of next year, that means that the Fed may be able to cut interest rate towards the year end, which means that mortgage rate may be pricing those future possibility into the current mortgage rate, so it could settle down at around 5.5%.
Lawrence, in terms of this weakness that we are seeing in the housing market, I guess how long do you expect that to persist before we start to see any improvement?
I think it's 1 or 2 additional months of low sales activity, because as you mentioned, mortgage rates have fallen for 5 straight weeks. And mortgage rate is always the key leading indicator. And all that will lead to buyers literally coming back to the market. And if the mortgage rate decline further, as I expect towards next year, then there will be greater number of people entering the market. The key question is whether there will be sufficient supply. Because again, we had the housing shortage, and then housing shortage does not appear to be at the present, but when the buyers come back, we could again face that issue.
All right, we're looking forward to next year, and you're showing us the top markets for real estate next year: Atlanta, Raleigh, Dallas, Fayetteville, Greenville, South Carolina, all pretty much concentrated, relatively speaking, in one portion of the country. What is it that connects these two? What's the common thread among these top markets you see for next year?
2 factors. Affordability. They are relatively affordable, definitely compared to, say, California market or New York. And the second factor is much faster job creation compared to the rest of the country. So a combination of affordability and strong job creation will lead these markets to outperform.
Are these markets that investors are eyeing right now?
There is a more than usual investor activity compared to other markets. Now, the investors are not interested in $1 million home. They're interested in those starter homes, which they get converted into rentals. So the investors are present, but I think the first-time buyers, they're eager to get into the market. And given that the prices are relatively affordable, if the mortgage rate goes down, continuing job creation in the local area, boom, you have the buyers coming in.
Lawrence, you just mentioned rentals there and what investors might potentially be doing with some of these homes that they are scooping up. When it comes to rent prices, we certainly have already seen a large jump this year. What are you anticipating that we'll see next year?
We have the record high, or I should say 40-year high in apartment buildings right now. So single-family home construction is down. So the home builders are suffering. But the apartment building is at a 40-year high. All this excess supply coming into the rentals market will calm down the rent growth. Rents have been rising faster than 10% in some of the private sector data. Now, CPI has not yet incorporated those.
Wow, I'll tell you, Mr. Lawrence Yun has covered so many topics. Let me share with you what's my takeaway. Some of you may not know, I'm in the real estate investing space. This means for the past 20 years, I've helped mom and pop real estate investors to buy cash flow homes, residential, single family home investing in the affordable and prudent markets. And this interview with Mr. Lawrence Yun, chief economist from NAR, he clearly indicates the top 10 housing markets are mostly in the South and Southeast: Huntsville, Alabama, San Antonio, Texas, Atlanta, Georgia, and Florida, and a few other places. So, and he mentioned those areas are affordable, those areas are entry-level homes, and the rental prices have increased by double-digit during the pandemic. Now they have subsided back to normal rental increases for single-family homes. So that space is doing very well as my investors are, investing in that market currently. So those entry-level homes like $150,000, $250,000, and because the rental market is so strong on a historical basis, there are a tremendous amount of renters they're willing to pay to rent this kind of homes during the 40-year low of home affordability. So the rental space, the rental market has been, the renters nation is historical right now. So for those of you average folks out there, landlords, mom and pop investors, buying in the South and Southeast markets, affordable entry-level homes, and put a tenant in place, you can get cash flow pretty nicely. So that's my takeaway. And also Mr. Yoon also mentioned the low supply. For years, this low supply has been really started since the last housing crash back in 2010. For the past 10 years, we'll talk about that momentarily. But yeah, I mean, and he also mentioned the mortgage interest rate potentially next year could fall below 6%, even 5.5%. If that's the case, I'll settle for 5.5%. So that will create a much healthier market, and the buyers will come back to the market. A lot of people waiting in the sideline, and I get it. But yeah, things are, this clearly there's no doom and gloom out there. There's the the sky is not falling. The market is not going to crash, and I'll give you the reasons why. So yeah, I mean this video interview is a very they summarize a lot of different things. So in terms of the mortgage rate, as we see right now, is at today as we speak. This Mortgage News Daily, dated December 23rd. 30-year fixed rate mortgage is 6.32, up by 0.04 basis point, and which is good, right? Which is the mortgage rate has decreased by 4 percentage points since October, a couple of months ago. So so that are creating a little bit more demand by some potential buyers. But I would say, the last few years is an anomaly. Look at the historical 30-year fixed rate mortgages. Look at, well, some of you don't follow history. I'm old enough to remember back in the early 1980, 81 to be exact. Look at this. Look at the 30-year fixed rate mortgage interest rate back in 1981. We're talking, what, 17, almost 18% interest rate. And you look at back in the 80s, 12, 13%. Okay, 1990s, 9%, 10%. Then only around April 2000, when the interest rate was around, actually 2002, when the interest rate fell to 7%. And then, of course, now at a couple of months ago at 7%, which is a 20-year high in a mortgage rate, but now has gone back down to 6.32. So, there's a lot of positive, healthy information, signs going on. So that's very reassuring. With the mortgage interest rate, hopefully the inflation will continue to go down throughout this coming year, and then the mortgage rate, if mortgage rate goes anywhere below 6%, I think people are going to feel more optimistic. The buyers, they will come back. A lot of them are in the sideline right now. So let's go with the Redfin weekly housing data. I know this is almost a few days away from the new year, so it's a very good timing for me to go over this big picture with the Redfin annual housing. So let's look at the new listings year over year, 2022 this year. Look at it, new listing is only like 47,000 homes are listed so far this year, down by 22%. So new listings was down 22% year over year. And then you have active listing for the entire almost 2022 this year. Active listings have gone down from the peak back in July. So we only have around 788,000. I know this is the last quarter of any year. We always have, it's all about seasonality. People are not doing real estate transactions during the holidays. So, and this kind of downward trend will continue at least through the first quarter of 2023. So all this negativity, all this downward trend, there's a reason for that. Look at pending sales, same thing. Pending sales at the peak back in May of this year, right? There were 74,000 pending sales about to close escrow back then. Now, as we go with the year December 18, 2022, the pending sale was down minus 37% year over year from last year. So, buyers are not buying because of a perceived higher interest rate, and people are just sitting on the sideline, and sellers are not selling because they are locked in to their historical low interest rate. So the median price, some of you are thinking, look, this is a Redfin covers 400 metros throughout the entire nation. You need to understand real estate is local. What that means is real estate is local. This means that it's hyper-local. This is nationwide. You have to take it for a grain of salt. So yes, there were some nationwide decrease around 10% of home prices ever since these past 6 months, actually, since June. Understandable, right? From 2021 to 2022, back in June, we see a 13% housing price rising. But by the end of this year and beginning next year, we can see probably no growth in terms of appreciation nationwide. That is, so you need to understand that the high price markets, such as the cyclical markets like in California and all those markets are, yes, they're going through a steep correction, 5, 10, even 15%. But there are many markets in a country where the markets have not decreased by that much. So yeah, you have to look into data more closely. And then what I'm going to show you right now, also the month of supply, as according to Redfin, I should have showed that slide, is right now is around 3.5 months of supply of inventory. So this means that we are still, if you can believe it, we're still in a seller's market, because a balanced market, a balanced, healthy market is 5 to 6 months of inventory. Even if we speak December 18, 2022, according to Redfin, we are only 3.5 months of supply of inventory. So it's still a seller's market. Some of you are in denial. You don't want to believe that, right? So again, each market is different. And anyway, so if you look at my chart, the slideshow, let me actually go back to the beginning. As I mentioned, I know some of you are first timers out there, are learning about real estate. A lot of you are millennials that are your generation. You have not gone back as far as I've gone back in the 1980s, 1990s, 2000s. But the mortgage rate is still pretty low, relatively speaking, on a historical basis, right? Look at this. Look at today's 6.3% interest rate. Look at the historical high of mortgage rate. So no time to panic. The market is not going to go upside down. So rates are still low, and yet ever since the last housing crash in 2008, look at the new home construction during the past decade. It's extremely low. The supply of new construction is extremely low compared to the population growth. Look at the prior to 2010, though, there has been a lot of construction, a lot of homes available supply-wise. But for the past 10 years, we have seen very low supply of new homes. And most experts stating that we are at a decade-long housing shortage. Some say around 6.8 million homes, housing shortages. And also, another chart I'm showing you, severe shortage gripping the nation's housing shortage. If you look at the next 10 years, right, from 2022 to 2032, we need around 2.5 million homes to meet the demand of buyers. See, 2021 to 2031, the next 10 years, even a more severe shortage than there has been these past 10 years. And another article states that housing shortage is worse than ever, and it will take a decade of record construction to fix. And another article states that America is short more than 5 million homes, and builders can make up the difference. And I'll go over the builder momentarily. Another resource says we are short 1.7 million homes. We need 15.5 million homes to be built in the next 10 years, and we're not building them fast enough. And also, you look at the supply demand. Let's go back to economic 101. When demand exceeds supply, we're going to have housing prices will increase. But look at this. Look at this chart. This is insane. This is such an eye-opening. Sellers are locked in to the mortgage. 9 out of 10 mortgages have an interest rate below 5%. More than 40% of homeowners don't even have a mortgage. They are free and clear. So this is, if anything else, one reason is the homeowners are sitting on massive amount of equity. So there's no stress out there in terms of sellers wanting to sell. Therefore, how can you see housing crash when the homeowners are locked in at a historical low rate and they have massive amount of equity in their homes? All right, so it doesn't make any sense. And then you haven't heard lately, this past year, the builder sentiment has been sagging. The builders are not building, are not creating permits. They are not building homes because of the temporary demand pullback by buyers due to higher interest rate. So, this lack of new construction in the next few years is going to have a consequence. It's going to affect the future supply of new home inventory, especially single-family entry-level homes. The builders these days, in order to profit, they're building homes typically more than $400,000, more than $500,000. So the entry-level homes are lacking nationwide, has been lacking for years now. Entry-level homes like $200,000, $300,000 new construction, the builders or the nationwide builders, they're not building these kind of homes. So that's gonna hurt first-time home buyers out there. And finally, not finally, look at this. Let me look at how many. More than half of the homeowners have 30-year fixed rate mortgage of 4% or lower. 1/4 of all homeowners have an interest rate of 3% or less. This is mind-boggling. People are hoarding these mortgages. This low interest rate mortgages is an asset to them, to homeowners. Why would they want to get rid of a 3 to 4% mortgage to sell their home right now to sellers, and in turn buy a home and having to finance a home for 6.3% or more? They have to double the amount of payments. It just does not make sense. So the homeowners have no incentives to sell right now unless the interest rate go way below 6%. And finally, again, according to Adam research, the inventory of home is, although there has been increased inventory the last couple of months, those increased in inventory are not going to make up for the lack of supply of homes coming down the pipe. So we are still seeing inventory shortages moving forward. And if the interest rate, if Lawrence Yung's prediction, the chief economist for National Association of Realtors, if he's predicting that the mortgage rate is sometime in 2023 to fall to around 5.5%, then a lot of people in the sidelines, a lot of home buyers in the sidelines, they can jump in, and it may be there's not enough supply of homes to accommodate those people that are getting off the sidelines. So, yeah. So the wise. Okay, here's my takeaway. My takeaway is, if you're buying a home, it's an owner-occupied homes, if you can afford it to buy a primary home to live, if you can afford it, right? If you love the home, if you love the neighborhood, if you can afford it, you should buy it. Even at a 6.3% interest rate, you can always refinance later, right? You married you married a house. You just date the interest rate. I know, some kind of corny. But for investors, oh, right now is a great time to buy because you can cash flow, especially when you buy entry-level homes in the top 10 housing markets, which we just indicated to you earlier at the beginning of this video. So very clearly, you buy investors, you buy in a good market, in a prudent market at entry-level homes. You can get a renter in there that can pay your rent, pay your mortgage, pay your debt service. All you gotta do is finance 25% down payment. There's a lot of incentive out there by the builders that will give you a lot of incentive on a rate buy down or on a cover your closing costs, or maybe even have a slight decrease of home prices. So right now is a perfect time to pull the trigger for mom and pop real estate investors to buy in a prudent market in the South and Southeast. Ignore all those trophy markets, those expensive markets that's going through a correction, such as avoid Las Vegas, Phoenix, Arizona, Boise, Idaho, Austin, Texas, and California, and the Northeast, Chicago, in the upper Northeast. Those are expensive markets. Those are cyclical markets. They are not for real estate investors. Real estate investors buy in the lowest entry-level homes, match a good rent to price ratio, good cap rate, good cash on cash return, and they are located in the South and Southeast, in which that's how I take my buyers there. So my recap is, yes, it's not a doom and gloom. There would not be a real estate crash because the supply of inventory still are very, very low, historically speaking. All the according to Redfin, the pending sales for the past 9 months has been decreasing, significantly. The new listings have been decreasing. People not buying, so sellers are, locking in their rate. They're not selling. No incentive to sell. The builders are pausing new construction. So all these trends, all this data clearly indicate that there will be a lack of supply moving forward, and then the demand will pick up soon as the rate falls below 6%. So watch, may not be first quarter 2023, may not even be second quarter 2023, but third quarter 2023, if the rate goes to 5.5% or even lower, we can have a housing frenzy. So don't wait that long to pull the trigger for you, because you'll be competing against many buyers for the limited supply of homes. So the smart thing to do is to get in there early when there's less competition right now. Again, whether you're primary home buyers or real estate investor, you buy right now because there's a good incentive, you are in a strong negotiation power right now. There's a lot of incentive out there. So anyway, that's my takeaway. Thank you so much and for listening. And if you enjoyed this video, please smash the like button and subscribe to my YouTube channel. You will receive weekly information about real estate nationwide and about investment real estate. And also, finally, please feel free to subscribe to my newsletter. Put my website below. Just put your email newsletter on our database, and you will receive free real estate investing information, so you can take action to become a good real estate investor. All right, thank you so much. This is Siwen Yi. I will see you on the next video soon. Have a nice day. Have a nice holiday. Bye-bye.